Good morning. Welcome to Stock Market Today. It's Tuesday, September 22nd, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at @Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email. Get a lot of the great content for this show. Also gives you daily stock ideas to consider, and that hits your inbox every trading day before the market opens. So U.S. equities were lower in Monday's trading, though off the worst levels of the day. Concerns about political volatility, heightened coronavirus concerns in Europe, and money laundering allegations against some big banks weighed on the market. Treasuries were unchanged to stronger at the long end of the curve. The dollar was better on the major crosses. Gold finished down 2.6%, and WTI crude settled down 4.3%. Commodities under pressure with dollar strength there. Outperforming sectors, tech was the only group to finish higher. Utilities and staples also outperformed. Laggards, materials, industrials, and energy. As we get to the desk this morning, futures are slightly higher after Asian markets were lower overnight. European markets are bouncing in the wake of a big sell-off yesterday. Treasuries are flat. The dollar is firmer against the euro and sterling, but not doing much against the yen. Gold is off 10 basis points. WTI crude is up 1.4% to kick us off on a Tuesday morning that sees us start the day after the S&P 500 reaches that 3250 level and reverses, right? So we were talking about below 3400. The next area of interest is around 3250. We traded down to that level. That was roughly coincided with this interim high here in early June before the market threw a little bit of a tantrum and pulled back. So should we hold here, we have to start thinking about upside back to the 3,400 area, right? That's kind of the key level that we were watching. When it broke, we got concerned, and then that now becomes resistance on the upside. Should we break 3,250, we have to start thinking about a move back down to the 3,000, 3,050 area. QQQ, the Qs here hold below the important 270 level, and the bulls want a fast recovery. Now, I am encouraged by the fact that the Qs did manage to reverse some intraday weakness yesterday to close higher on the day, and we'll talk a lot about semiconductors later on in this show. But the bulls do want a fast recovery in the Qs, and I think we could be setting up for one potentially in the near term. IWM, that one was a mess yesterday. Small caps can just completely breaking down below the 150 mark. So again, bullish investors want to begin to look for a fast recovery back through that 150 mark on the small caps, if for nothing else, not so much for a leadership perspective, but from a breadth perspective, right? I'd love to see small caps going higher. If they're outperforming, great. But even if they're not outperforming, just the fact that more stocks are moving higher is a bullish breadth development after those massive divergences that we've been talking about for months, leading into this 3-week sell-off here for equities. So let's hit our market in a minute. What are we writing about today? SPY reaches next support at 325, and we think there could be signs of some selling pressure abating there. Early signs. While QQQ staged a reversal to close higher on the day, that was important. The relative trend in technology remains to the upside as far as I'm concerned, and now we're starting to see a reassertion of relative strength in the semiconductors, which I think is encouraging. And as I said, futures do point to a higher open here today. Turning now to the power bars across the major indices, deterioration would be the word over the past 3 weeks. So the Dow was down 1.8% yesterday, 4 to 6, bulls to bears there, flipping to the bearish side of the coin. S&P 500 down a little over 1%, flips bearish, 108, 108 to 119 for the ratio. NASDAQ is an even ratio after adding 24 bips yesterday, 16 all on the bulls to bears. Small caps, massive underperformer yesterday, 3.5% to the downside as investors maybe coming off that trade a little bit, starting to rotate back into some of the bigger growth leaders. Still a bullish ratio, 502 to 344. Bonds upticked, sending yields lower. Flight to safety there, especially at the long end. According to the Chaikin Power Bar, small cap stocks have become somewhat more bullish than large cap stocks, and the major indexes are mixed. Let's hit our stocks of the day, sticking with this theme of a couple days a week, just running through a screen that I think is compelling. So if you recall on Friday, we highlighted the fact that growth stocks had pulled back, and if they were going to rally, this would be the spot to reassert their relative strength, especially against the value names. Early days, but some signs of stabilization in that support zone. So what I wanted to do here today for the screen was look at our growth stock universe. Identify stocks that have a rating of neutral plus or better, i.e. bullish fundamentals within our 20-factor model. Then I want the names that are oversold because I'm looking for ideas that could be actionable in this week and are still showing relative strength. So if you think about what that is, these are stocks that have pulled back with the market but are still outperforming, right? That's your relative strength, and are now oversold, setting up potential entry points for compelling names, especially if we can continue to gain confidence that growth theme is reasserting itself. So names that jump out at me are some of the big ones within the tech landscape: Accenture, Adobe, Salesforce, NVIDIA is a name to look at. Synaptics, important name in the semiconductor space. Zoom, great day yesterday on the resurgence of coronavirus fears, COVID-19 fears, really helping out a lot of the stay-at-home stocks. PayPal, similar theme. It's a name that I've liked for a while, and actually, quite frankly, I'm looking for an opportunity to get back involved. So this is an interesting screen here, 32 names to potentially do more work on and look for some opportunities. You can see some themes. Again, PayPal and Green Dot are interesting plays within the Corona landscape and what that could mean for cash, physical cash. Starbucks, compelling name as well, of which I am a shareholder. So take a look at this screen. I think it's a compelling place to start to do some more work. Let's look at our sector tracker now. Movement of the major sectors over the last 5 days. Red across the screen as the sell-off intensified into the open yesterday. Tech at the top of the list, though, is an outperformer over the last 5 days of trading, and you like to see it. In my note today and a little later on the show, we'll look at the relative trends in tech. Energy, maybe early signs of potential relative bottoming process, okay? I hesitate to call it any more than that, but I'm going to be fair. I've been a hater, and when I do see signs of a potential change, I want to call it out and start to pay attention to it. So that's what we're going to do there. Healthcare rounds out the top three. Middle of the road, staples, comms, Utes, industrials. All still lower by more than 3% over the past 5 days. Discretionaries come under some pressure here as the retail trade has come off over the past couple of days. Materials hit hard yesterday. That was our favorite group within the cyclical landscape. Got a little ahead of itself. Commodities got a little ahead of themselves. So now we'll look for some signs of stabilization and a resumption of that trend. I don't think there's anything to worry about just yet, but you never know. So that's why we manage risk. Financials under pressure with the banks yesterday, and real estate coming off, especially once again with rising fears of coronavirus at the bottom of the list. So let's hit our industry in focus. Today's show is going to be heavy on semis. The industry in focus is auto-generated, right? So whatever I'm writing about in my note is previous to putting together the material for this show. But semi services over the past 6 months been an outperformer, 15.5%. Power bar ratio here for XSD is weak. SMH is a little bit of a different structure. So, but here XSD 5 to 7 bulls to bears, 15 of 21 subsectors moved up one slot over the past week. Lattice, Impinj, and Inphi are very bearish names, but you know, those of you who have been following me for a long time know I like to look at semiconductors as a tell. In particular, XMH, I think it's a better example of the semiconductor supply chain. But what I see here is a bullish fund, right? We went below the trend line yesterday. We'd like to see it quickly regroup, right? But we have this pull back into support, right? So, you know, top, breakout, pull back into support. Oversold. Money flow has been mostly bullish, kind of a hiccup here. But what's interesting to me from a market perspective, more so than the semis themselves, but from a market perspective, what you'll notice is a persistent relative decline, right? Not underperformance, but remember, this is a 6-month time frame, so we can start to see the shift, right? So recall back at the end of August as this shift was starting to play out and continuing to play out, rather, we started saying, don't chase the growth stocks, right? Don't chase growth. Growth was extended. You connect the dots with semiconductors beginning to underperform, and you say to yourself, wow, these mega cap growth stocks, tech levered, have probably gone too far, too fast. Don't chase them, right? So now you go back to the slide that I showed you last Friday of growth over value pulling back into support, right? And we're saying, okay, if we're going to rally, this would be the place to do it. Now connect the dot to the fact that this relative strength is starting to move higher once again. oversold, right? Still in an uptrend, holding support, but the uptick in relative strength is an encouraging sign that that growth over value theme may begin to reassert. So that's an interesting development. That's why I ran the screen that I ran. So we start to connect the dots, and you can start to see it's not one data point out there. You pull it all together and start to come up with probabilities. Probability favors growth stocks holding that support zone in the near term. Let's hit what's trending now. Yesterday's S&P 500 movers and shakers, gainers and losers. There's your PayPal. Barron's article over the weekend, as well as COVID concerns. Semis were strong yesterday, rebounded nicely. AMD up 4%. DGX, UBS note, positive commentary up 3.76%. Netflix and Take-Two are your stay-at-home plays as COVID fears reemerge. On the flip side of that trade is Delta Airlines down 9%. Retail REIT, FRT, right, getting hit. UAL getting hit. There's your COVID trade to the other side. Illumina, investors just continue to be upset at their deal for Grail, taking another 8.5% out of that stock yesterday. And then UHS was downgraded at JP Morgan, and that hit that stock for 8.5%. So let's dive into the charts. The tech trend is intact. Okay. Pressure, yes. Intact, yes. Got ahead of itself, yes. Stabilizing here, perhaps. Connecting the dots, okay. XLK relative to SPY. Here's your trend. That's up. That's 200-day moving average. That's up. Okay. The RSI of the ratio pulled back with price, but held a bullish range, right? Remember, the RSI tends to shift, and in a strong uptrend, you're never really going to see it get oversold because there's strong upside momentum, right? So the lower bound shifts up to the 40 to 50 area where we found ourselves over the past couple of weeks and now beginning to stabilize. On an absolute basis, you can see tech pulling back to this July-August consolidation area, looking to hold that area. So the tech trend to me remains intact, encouraged by improving relative strength in the semiconductors. That feeds through to the growth theme once again. Is it guaranteed? Absolutely not. Nothing's guaranteed to happen. I'm just trying to connect the dots here. And when growth over value is 20% above its moving average, like it was at the end of August, we say to ourselves and to you, this looks extended, don't chase it. And then we watch how it works off that extended position. And then we reconnect the dots again and say, okay, we've fallen back into this support area. It kind of looks interesting to me. And part of that is semis potentially reasserting their relative strength. Here's SMH. I prefer this one to XSD. SMH relative to SPY, still in an uptrend, right? But here was that hiccup, right? That kind of tantrum here, if you will. This pullback on a relative basis, which led to the growth theme coming off, which led to pressure in the Qs, which led to pressure in the market. Okay. Now the flip side, breaking back above the declining trend line in the near term. RSI held the lower bound of bullish ranges back above the 50 level, all while SMH is kind of holding this consolidation here on an absolute basis. So those are the dots that I'm connecting. It kind of looks interesting to me here in the near term. Next leg to increase conviction would obviously be the Qs regaining 270. That happens. So to me, the way I'm seeing it is you start to put some money to work in those growth names again that have gotten beat up but are still in uptrends, right? Look at the screen that I produced. And then, it's not an all in, all out, right? You find the best opportunities. You redeploy some of the capital that you might have built up as stops were triggered on the way down. And then you look for these opportunities to reassert. You reset your risk management process, and then you gain conviction, right? If the Qs start to retake 270, if semis continue to outperform, your conviction levels grow, your position sizes can get bigger. Finally, utilities are what we want to see. We want to see this breakdown, right? If you're bullish, you want to see the utilities breakdown. No two ways about it. That'll wrap us for today. Have a great Tuesday, everyone.